Welcome to Bankable. I'm Doreen Abisundra, your host and a proponent of innovative technology and financing solutions for AI infrastructure, decarbonization, and energy security. This is the first Bankable podcast to showcase AI infrastructure. What, you may ask, is AI infrastructure? Also referred to as an AI stack, it's a collective noun for the hardware and software needed to create and run artificial intelligence applications. An example of hardware is the graphics or tensor processing chip, the GPU or TPU, with a cloud provider such as a hyperscaler being an example of software. A data center houses this infrastructure with the electricity needed to power the process as a key AI infrastructure component. Why the interest? Well, as set out in the International Energy Agency's April report this year on energy and AI, electricity consumption by data centers is projected to at least double between 2025 and 2030. The IEA highlights that AI has the power to transform the energy sector, yet there is no AI without energy. Today, we meet the International Finance Corporation's Data Center Global Sector Lead for Investments in Emerging Markets. As Obina shares in his written posts, the world needs $6.7 trillion to fund the next generation of data centers. Fresco Cleantech Solutions observes that not one nation's infrastructure plan currently includes a doubling of energy sources within the next 5 years. Hence, this is not just an investment opportunity, but a paradigm shift in the global electricity consumption and generation requirements. What a fantastic opportunity we have today to have Obina Isiadinso, the Global Sector Lead for Data Centers for the IFC. Obi, thank you for being here. So lovely to see you again, and really looking forward to having this conversation with you. So for the benefit of everyone who's listening, Obi, tell us, who are you and how would you describe your current profession and your career history?
Yeah, thanks so much, Doreen. And, look, the way, again, my name is Obina Isiadinso, or Obi for short. I'm the global sector lead for data center investments for the International Finance Corporation, or the IFC. And I'm basically an investor in data center projects in emerging markets globally. My background and career is actually, I've been an investor in emerging markets now for, since 2008. I've been essentially a private equity investor in Africa and other emerging markets. Originally, my family is originally from Nigeria. I was born in New York and spent 10 years actually growing up in Nigeria. And that experience is actually influenced me significantly. Growing up as a young child in Nigeria exposed me to Africa, exposed me to the Nigerian cultures, a lot of the opportunities and the challenges with emerging markets, and that really has influenced my career. And that's one of the reasons why I've spent the past 15, 20 years as an investor, and particularly as an investor in emerging markets globally.
Wow, how incredibly amazing, fascinating. So tell us now a little bit more about what your company, the IFC, does, and what exactly is the product and the service that is provided by the IFC, especially in your role. And obviously, please provide us with some kind of layperson's terms so that we can fully understand the brilliant work that you're doing.
Yeah, thanks, Doreen. So, we are the IFC, we are the private sector arm of the World Bank Group. And so the World Bank Group includes the International Bank for Reconstruction and Development, IBRD, includes the IFC, and also includes MIGA, which is essentially the guarantee arm of the World Bank Group. And so the three arms, we work closely together. But our role is really focusing on investing in private sector companies and infrastructure projects in emerging markets globally. And so the way to think of about us is we are a combination of both a medium to long-term financial investor, very similar to a private equity investor, and we're also a major lender to companies and for infrastructure projects globally. We have a $100 billion balance sheet, and about 70% of our balance sheet is made up of direct investments in companies and infrastructure projects. We're investing in sort of three major sectors, so infrastructure, financial services, and then what we call MAS, or manufacturing, agriculture, and services. Within our infrastructure business, we have about a $15 billion global portfolio, and we're investing across infrastructure. So think about power, water, utilities, and digital infrastructure, as well as several other segments. And then within our digital infrastructure business, which is a little over a $2 billion portfolio today, we're investing in four core verticals, which includes data centers, towers, mobile operators, and broadband companies. And then we've also recently added media and infotech. So these are two additional new sectors that we're investing in. So together, we're investing across these six digital infrastructure sectors, and we are the largest investor in digital infrastructure in emerging markets. So about 40% of all of the investments in digital infrastructure in emerging markets is coming from the IFC. As I mentioned, this year we're going to commit about 4 billion, at least 3 to 4 billion of financing to investments in digital infrastructure in emerging markets globally. We're more, as I mentioned, we're more of a medium to long-term investor on both the equity side and on the debt side. In terms of data centers, we're a lender and an investor in retail enterprise, wholesale hyperscale, and AI data center projects. And so we're providing financing for both greenfield and brownfield data center projects, as well as acquisitions in the sector. I should also say that in addition to these investments in data centers, we're also investing in other parts of the value chain, other parts of the data center value chain. So we're investing in energy companies as well. And we're also looking for opportunities to make investments in water. So we're really, we have the benefit of a sort of a one-stop shop approach, because we're investing in multiple parts of the data center value chain globally.
This is beyond phenomenal. That's extraordinary. What you've described, in particular, the fact that you are in the emerging markets, providing a financing solution there. So that's a perfect segue to our third question, which is, how is your company contributing to decarbonization, AI infrastructure, and energy security? How are you helping to attain the holy grail of financing, so to say?
Yeah, thanks, Doreen. I would say three things. One is every investment that we're making in the data center sector, we consider to be essentially a green data center. And we say that because the data centers that we're financing, they are essentially achieving one of sort of three key sort of KPIs. And so they are, they're being designed to achieve, a very high level of renewable energy in terms of supply to the data center. And so that's one of the key KPIs. The use of proceeds in terms of where the funding is going to, in terms of developing the actual data center project, the funding is usually going to secure elements or products that will be considered sustainable, as a part of the overall development of the data center project. And then the third point there is that, these data centers are also going to be certified. They're typically, eligible to be certified by the IFC Edge certification, which is a green building certification, or some other certification as well. So for those reasons, all of the data center projects that we're investing in, we consider them to be green, sustainable data center projects, and that's really important because we're essentially expanding, the supply of sustainable data center infrastructure in emerging markets, which is very important. I would say that, in terms of your point on AI infrastructure, one of the things that we've noticed is that the hyperscalers who really drive the growth of this of the data center sector, the hyperscalers are responsible for 80 to 90% of all new data center developments globally. And in emerging markets, what we've seen is that the hyperscalers outsource about 90% of their data center development, as opposed to in developed markets where they're developing 80 to 90% of their own data center infrastructure. And so in emerging markets, we are investing and financing the data center operators who are building the majority of that data center infrastructure for hyperscalers. And we have noticed that, the hyperscalers are prioritizing markets like Brazil, India, Malaysia from an AI perspective. They are still investing in cloud and hyperscale infrastructure in other markets, but their main priority from an AI perspective is actually their home markets of the US and potentially certain markets in Western Europe. But in emerging markets, they've sort of prioritized just a few markets, and those markets tend to be the large regional hubs. So that's why I mentioned markets like Brazil, India, and Malaysia. And in fact, one of our recent investments, we provided 150 million of debt financing to Yonder Group to develop an AI data center facility in Johor, Malaysia. And so that's a perfect example of how we're supporting the development of AI infrastructure. So and I should mention that we're also we've been investing in the data center sector since 2010. We started off as an equity investor in small retail enterprise data center projects in Russia, Ukraine, India, and China, and South Africa. And then in 2020, we expanded our strategy to become a lender and an equity investor in wholesale, hyperscale, and AI data centers. And so now we are co-investors with Digital Bridge and Scala data centers in Brazil, in Ames in Malaysia. We're also co-investors with I2 Capital and Kio Networks in Mexico. We're lenders and equity investors in Liquid Telecom and Wyok in the Africa region. And those are both Pan-African data center connectivity and data center providers. And I just mentioned Yonder Group in Malaysia. We're a lender to Yonder. And our most recent commitment in the data center sector is to Raxio Data Centers, where we committed financing to support the company to develop a Pan-African retail enterprise data center platform. And so in those large regional hub markets, in the emerging markets, that's where we're seeing more demand from an AI perspective, whether it's a combination of hyperscale or enterprise AI demand. That those markets, Brazil, India, Malaysia, they seem to be driving the AI demand. But what we've learned over time investing in the sector is, these markets grow at different paces. And so 3 years, 5 years from now, we'll see more of these markets where there will be more demand for AI infrastructure. And we will be, looking to support the growth of that infrastructure in those markets as well.
That's a absolutely fascinating financing journey, effectively, that the IFC has been on, but also a journey that you've helped the local developers to pursue. How is the IFC assisting with the emerging markets' current or future financing needs?
Yeah, Doreen, there are a few ways where we as IFC are looking to support clients in emerging markets in regards to financing to help to grow this sort of AI data center infrastructure. We're expecting that, firstly, that in terms of providing debt financing, that really will be a major source of support. These projects these AI data center facilities tend to be quite large. They tend to be somewhere between 100 megawatts to 1 gigawatt in size. And from a cost perspective, we typically see these data centers being developed at somewhere between $10 to $12 million per megawatt. So we're looking at a minimum, $1 billion project on the low end, and potentially multiples of that, tens of billions on the high end. And so that's a lot of capital that's required. And typically, from a loan to cost perspective, the debt financing that is being provided to these data center projects tends to be somewhere in the 60 to 80% range. And so there's a large amount of debt financing that will be required to support the development of these projects. And so we will, that's an opportunity for us. And so we're looking to provide debt financing and also to mobilize debt financing over and above the exposure levels that we can take. And so ourselves, a combination of using IFC's balance sheet and then syndicating and mobilizing other lenders together, we're looking to provide the debt financing for these larger AI data center facilities, and that's really going to drive, I would say, the majority of the financing needs in the sector. There will be an opportunity to provide debt financing for retail enterprise data center projects. These tend to be smaller facilities. They could be anywhere from 1 to 10 megawatts. And so it will be the demands in terms of the financing needs will not be as large as AI infrastructure will be. And so we're expecting that there will be an opportunity for us to provide debt financing for retail enterprise projects. We will also still look to provide equity capital to support the growth, expansion of data center projects. Most of the investments that we've made since 2020 have actually been in regional platform businesses. So these are companies that are operating data center projects across multiple countries within one region. And just because of the economies of scale that we see in the data center business, we're expecting that those players who have that type of scale, who are operating across multiple countries, who can provide data center solutions and infrastructure to hyperscale clients across multiple countries in one region, they are likely going to have a competitive advantage over the long term. In smaller markets, or where there are smaller players potentially, we'll still look to provide some sort of direct investment, but we'll also look to gain exposure to maybe smaller markets, sort of secondary, tertiary markets through some of these platform investments that we're making. So we'll basically use this combination of debt financing and equity capital to support the growth of the sector. But we're expecting that the majority of our investments will be in the sort of wholesale, hyperscale, and AI segments of the sector, just given the size and the financing needs of those types of facilities.
And perhaps one of the key questions we should ask is, why is there this exponential need for AI infrastructure in the emerging markets? It is pretty obvious, perhaps to some, but it would be really helpful to hear from you what is driving that take-up and what would happen to the financing of these AI infrastructure needs if the IFC and the equity and debt that you're providing was not there.
Yeah, look, it's a great question, Doreen, and the short answer is that if the IFC wasn't providing this type of funding capital for data center projects in emerging markets, in certain instances, some of these projects may not be able to move forward or potentially get off the ground. Many of our markets are considered more risky by developed market investors, and there isn't as much familiarity or potentially comfort with a lot of the markets where we're investing in. We know these markets. We have been investing in these markets for 25 years, in terms of digital infrastructure. We've been investing in emerging markets for 65 years. We have offices in over 100 countries globally. So we have a lot of experience with these markets, and we have relationships, whether it's on the World Bank side or with MIGA. We have relationships with regulators, and so we're able to sort of develop a comfort level in terms of the risks and the challenges associated with investing in these markets, and we're able to then develop innovative financing solutions that will allow us to protect, obtain some sort of downside protection while positioning ourselves for upside in the future. And so yeah, that's sort of one of those would be the implications if we were not providing this capital for these projects. Yeah, Doreen, look, the drivers of demand here are very well known. Partly it's driven by a lack, essentially, of this type of infrastructure in most emerging markets. Most emerging markets are underinvested when it comes to data center infrastructure. For example, Africa represents 15% of global population, but less than 1% of data center infrastructure. For example, India today has a data center capacity of about 1.2 gigawatts, and for a population of 1.2 billion people. And on a relative basis, Northern Virginia has about 3 gigawatts of data center capacity, right? So you can see that most, for example, even in Brazil has a population of around 250 million, and it has around 500, 600 gigawatts of data center capacity. So most emerging markets, and these are some of the larger markets I'm giving you an example of, but the trend is the same, that most emerging markets, given their population, given their growth, given the demographics, and given the trends in terms of increased mobile penetration, increased mobile data, the increased submarine cable infrastructure that is that's coming into most of emerging markets, particularly in LATAM, in Asia and Africa. There's really just an explosion of data demand, data traffic, lower costs for data, and that is really driving demand for data center infrastructure, cloud and hyperscale infrastructure. AI demand is actually a very recent new tailwind to support growth, right? So we're sort of, if I had to put it in baseball terms, this is the first or second inning in terms of AI demand. We're still learning about what are going to be the use cases for AI, but we know that at this point in time, there's a need for training models, and then there's a need for using those models in terms of inference. And those models are going to be, they can be used by enterprises, and they're going to be used by consumers. And so, for example, ChatGPT has something like 500 million users now using their models. And that's just in the space of maybe 2 years. And that's one of the fastest adoptions of technology that's ever been seen. So we're just in the beginning. There will be a lot more models that will be released over the next 5, 10, 15 years. Again, all of these models, and then there will be enterprise models where companies are developing models for their own use cases, right? That won't be available on the public cloud. So, and as I mentioned, there will be future use cases that we can't even imagine, that we don't even foresee today, because as you know, we are 30 years into the development of the internet, and if knowing what you know now, 30 years ago, we wouldn't have imagined the use cases for the internet that we're seeing today, right? And so so AI is just the most recent sort of tailwind for data center infrastructure. And there will be enterprise use cases, there will be hyperscale use cases, and there will be other use cases that we're yet to envision. But the training use cases are significant, because these require large scale facilities between 100 megawatts to potentially 1 gigawatt in size. And the inference use cases will be data centers that are smaller. So they could be anywhere from maybe 10 to 50 megawatts in size, potentially even smaller. And so that's really what's driving the demand on the AI side.
Incredible. And these smaller data centers that you're discussing and highlighting here, do they specifically have a greater use in the emerging markets?
So they don't necessarily have a greater use, right? The way to think about these, what I would call these inference uh, AI facilities, these are going to be, typically they're using what we would call sort of very high density equipment. So the racks tend to be much higher density, so they're using a lot more power, and because they use more power, they need a lot more cooling, right, to keep the equipment cool and to keep the facility cool. And so these types of facilities tend to use newer liquid cooling technologies, whether it's cooling to the rack or to the chip. And so that's typically what we see, and it's more expensive. So investing in that additional sort of cooling technology can be more expensive, but it's required because of the high density nature of the equipment that's being used to run these algorithms, and to essentially to perform the different queries that are being provided by users. And so what we're expecting is that these smaller facilities, we're more likely to see them in more markets, in secondary and tertiary markets. We're not likely to see the training models across all markets because we won't be able to. There are only a few markets where the hyperscalers will be able to secure the amount of data center capacity that they need to train these models effectively. So there are only a few markets where you can get 100 megawatts and scale up to 1 gigawatt and get renewable energy to power those types of facilities. And so markets like Brazil, markets like India, Malaysia, potentially markets like Kenya, there will be a number of these markets where it will be possible, but it's likely going to be more focused on developed markets for now in terms of where we're seeing the majority of these training facilities. But in emerging markets, we'll see them in these first three markets that I mentioned, and then over time there will probably be additional markets like in the Middle East, for example, in the UAE and Saudi Arabia. We're seeing a lot of announcements in regards to the development of AI training facilities in those markets because they will be able to provide the land and the power and the technology that's required to scale. But in most other markets, secondary and tertiary markets, we're expecting to see smaller facilities that will cater to providing AI sort of inference infrastructure to local enterprises, local consumers in each market. And those facilities can be smaller. As I mentioned, they could be 10 megawatts, 5 megawatts, potentially up to 50 megawatts.
Astounding, really astounding. And so our fifth question here is to highlight the role that, in your case, the IFC is playing in balancing the risk return discussion that's had between investors and those that need that investment. Effectively, would we be fair in suggesting that the role that the IFC plays makes the data center, the AI infrastructure market bankable for investors and lenders? Would that be a fair comment?
That's a great question, Doreen. And look, the short answer is, we're looking to finance bankable projects. That's really the bottom line. Our experience has been that we, as an infrastructure lender and investor, it's really we really have to look at each sector, each infrastructure sector differently. For example, in energy, there have been instances where there have been merchant power companies where investors have financed those types of businesses, and there in some instances some of those projects were not bankable, and those there have been challenges with those types of investments in certain markets. On the data center side, because we're seeing a lot of growth, our colleagues in terms of on our credit colleagues, this is definitely an area of focus and concern to make sure that we're financing what we consider to be bankable projects. So we tend to be very focused on what are the supply demand dynamics in individual markets. Is that supply demand dynamic, is it attractive or not? Is the market potentially in an oversupply? So that tends to be one major area of focus. I think the other major area of focus is we have a preference to finance contracted hyperscale data center projects, right? It can be it's very competitive now from a financing perspective to secure those types of financings, because once the project is contracted, there's just a significant amount of capital that's available to finance those types of projects. And so in certain instances, we will look to provide pre-contract financing. And the Yonder Malaysia transaction is a perfect example of that. We were able to provide Yonder Malaysia with the Yonder Group, a total of $150 million of debt financing to develop their 98 megawatt hyperscale facility in Johor in Malaysia. We provided that financing in two tranches. The first tranche of 50 million was pre-contract. So they were able to use that 50 million to complete the construction of a core and shell of the facility. And while they were completing that construction, they were actually out looking to essentially secure the contract for that facility. And then fortunately, 2 months after we disbursed that first tranche, they secured a contract for the entire 98 megawatts. And then we provided the second tranche of 100 million towards $1 billion project to build out that 98 megawatt facility. And we were able to structure that two tranche facility in such a way that we were essentially, that first tranche was oversecured from a collateral perspective based on the security that Yonder Group had provided to us in the Malaysia project. So that was the first time we had ever structured a facility in a debt financing facility in the data center sector in that way. Our prior experience had been as a lender for contracted hyperscale projects in Brazil with Odata and in Mexico with Odata as well. So we had financed 2 to 4 megawatt hyperscale contracted projects, and so we were very familiar with the hyperscale sort of development and financing process. But over the past 2 to 3 years, one of the trends that we've seen is that more and more data center clients are seeking debt financing prior to signing a contract, partly because there's more competition from other operators to secure attractive sites, and partly because of pressure from hyperscale customers who want to achieve aggressive RFS dates, dates when they want their data center infrastructure to be delivered. And so because of that, data center operators frequently are looking to develop these data center projects in a parallel fashion instead of sequential. And so instead of waiting to get the land permitted, bring the power to the site, and then signing a contract and then securing financing, they're actually pursuing a lot of these steps in parallel, so that it allows them to potentially cut down the overall timeline to develop the data center and provide the final the completed infrastructure to the hyperscale customers. So that this is one way in terms of structuring this type of a two tranche financing and providing some financing pre-contract and then providing additional financing post-contract. That is one of the ways that we're looking to support data center clients that are looking to develop these large AI types of projects in emerging markets globally.
Excellent. And I cannot let you go without maybe giving us a little prediction on what's the next emerging market that you and your team might find interesting, not just for yourselves, but for the investors that are tuning in.
Yeah, it's a great question. Look, Doreen, Africa definitely is going to be one big area. As I mentioned, with a population of 1 billion people, and less than 1% of data center infrastructure, there's going to be a big opportunity to develop, AI infrastructure in the Africa region. South Africa today is a major cloud and hyperscale region. We would expect to see more AI infrastructure being developed in South Africa over time. And then Nigeria and Kenya, they should start to see more hyperscale expansion into those markets. And then even in North Africa, in Morocco, in Egypt, and maybe some secondary markets like Ghana. So we're expecting to see a lot more growth in the Africa region over the next 5 to 10 years. In Asia and in LATAM, we're expecting to see a lot more interest in some of the secondary markets. So markets like Philippines, Vietnam, Thailand, Chile, Mexico, Colombia. We're expecting to see a lot more growth driven by hyperscale expansion, and then eventually AI use cases in those markets as well. And then obviously, in the Middle East, we've talked about the growth that we're seeing in UAE and Saudi. There's going to be significant expansion in that region. And then in Eastern Europe, I think Poland is going to be another market where we should see a lot more growth over the next few years as well.
And this is a bit of a bonus question, and I'm quite keen because, as you know, there is a growing demand and interest in new nuclear. So tell us a little bit about your thoughts on AI infrastructure, new nuclear, obviously from a position that you can represent within your institution as the IFC, which is part of the World Bank.
Yeah, look, Doreen, in terms of nuclear, a couple of things. One is, that as a World Bank group, we are looking into nuclear energy, and we are exploring ways where, what sort of role we want to play in terms of supporting this type of, energy. In terms of data center infrastructure, there's a need to look at energy from a diversification standpoint. Typically data center projects they're designed to always have a primary and secondary and sometimes a tertiary source of energy. Typically in most markets, the grid is the primary source, and then the secondary and tertiary sources can be backup. And that could be, a combination of either renewable energy or other sources of energy. And so we're seeing a lot of natural gas projects as either a primary or potentially or secondary source of energy. We are seeing, obviously a lot of solar, wind energy that is being, provided to power data centers. Nuclear energy is more of a developed market phenomenon today. So it is something that is being seen primarily in North America, in the US. We're not seeing that. It hasn't proliferated yet into emerging markets. There are only a few countries who have that type of technology. And nuclear does come with higher costs and longer lead times. So it's likely going to be at least another 5, potentially, up to 10 years before we see the first forms of nuclear energy that's being supplied to data centers. We are seeing that the hyperscalers are looking to acquire stranded nuclear assets as a way potentially to manage that long lead time. But it will still take some time before we see the first sort of forms of nuclear infrastructure, whether it's small modular reactors or existing kind of stranded nuclear infrastructure that is being used to provide power for large-scale AI infrastructure in the U.S. But in emerging markets, I think we're still quite a ways out before we start to see nuclear infrastructure being provided to data center projects. Again, partly because of the scale, because there are only a few countries where that kind of scale will be required. And then there's obviously regulatory issues involved with each country as well. So, but it is definitely becoming more of a area of interest in terms of being included in this overall energy mix for energy to data center projects.
Obi, this has been just a tremendously insightful conversation. Thank you so much for taking the time to share the depth of the knowledge that sits within you and your team. And I cannot wait for us to see more of what you and your team are doing in the emerging market sector. Thank you so much.
Yeah, I want to also just thank all of my colleagues that I work with globally in across our regions in LATAM, Africa, in Asia, Eastern Europe, Middle East, and really a lot of this work wouldn't be possible without the support and the relationships and their experience and knowledge of these markets. So I definitely want to thank them for all of their efforts.
Brilliant. Thank you.
Thanks.
Thank you for listening to Bankable. For early access to energy transition pioneers and to learn how to structure the investment solutions described in this episode and throughout the series, subscribe to the podcast and get in contact at frescocleantech.solutions.